Today, we will talk about loss reserves, what they are and examples. A loss reserve is an estimate of an insurer's liability from future claims it will have to pay out on. This means that it allows an insurance company to cover claims made against their insurance policies. Determining these liabilities can be complex, taking into account factors like the duration of the insurance contract, type of insurance, odds of a claim being made, and time of resolution. Insurers must constantly adjust their loss reserve calculations as circumstances change. When an insurance company underwrites a new policy, it records a premium receivable as an asset and a claim obligation as a liability. The liability becomes part of the unpaid losses account, representing the loss reserve. The complex calculations for loss reserves matter because losses can occur at any time, even years down the road. For example, a final settlement of litigation with a claimant may require a multi-year court battle, draining the insurance company's funds over a long period. Maintaining an adequate level of loss reserves puts an insurance company in a better financial position for claims and legal battles. The correct estimation of a loss reserve is crucial for an insurance company's profitability and solvency. If the reserve calculation is too conservative, it will reduce their income and asset investment ability. If too liberal, it could result in booking losses and possible insolvency. Insurers use present value to calculate claims, allowing them to discount future claim payments and understand how much they need to reserve today. However, regulations require claims to be recorded at the actual value of the loss, leading to higher reported liabilities. Loss reserves also impact an insurance company's tax liabilities. Regulators determine taxable income by adding annual premiums and subtracting increases in loss reserves. The addition of loss reserves into financial statements can also lead to income smoothing. In the banking industry, loss reserves are known as loan loss provisions and are used to manage books in a similar way to insurance companies. Lending institutions use loss reserves to manage their books, known as loan loss provisions in the banking industry. For example, Bank ABC estimates that 2% of its loans, or $200,000, will probably never be paid back. This estimate is recorded as a loan loss reserve on the balance sheet. Calculating and maintaining loss reserves is crucial for both insurance companies and lending institutions. Here are 5 key takeaways. 1. A loss reserve is an accounting entry that estimates the amount an insurance company would have to pay out on future insurance claims on policies that it has underwritten. 2. Calculating loss reserves is a difficult process as it is an attempt to guess when and how many claims come due that the insurance company will be liable for. 3. Regulations require loss reserves to be reported at nominal value, whereas insurance companies would prefer them to be reported as a discounted present value loss. 4. Estimating the correct loss reserve is important for an insurance company as it directly impacts profitability and solvency. 5. Loss reserves, when applied to the banking industry, are known as loan loss provisions. Hope this would help. Thanks for watching.